Welcome back to the Mobile Mailbox Money Podcast here, episode 32 with Mark Monroe. Today's brought to you by Silvercrest Opportunity Fund. Invest accredited for terms as low as 1 year and 10% or better. Hello, everyone. We're here back on the Mobile Mailbox Money Podcast here, episode 32 with Mark Monroe of, creative finance guru, magnate of seller finance strategies, done $500 million in seller finance paper, expert strategist in the program. Mark, appreciate having you on the channel today. Met you at multiple real estate note investment conferences. If the people haven't seen you on my channel, maybe you could just introduce yourself real quick for the viewers that don't know you.
I appreciate it. Thanks so much for having me on. It's always a pleasure. I always enjoy having great conversations with yourself and your father and your whole entire group that you guys have going out there. It's just impressive what you guys have done. But yeah, I'm currently in Boca Raton, Florida. I am from Vermont. I stopped in Washington, D.C. for about 10 years. That's where I started my career. Going to show my age here. Started at the age of 24, 25, back in 1995. Done 30 years in the business. Started out as a mortgage loan officer broker, became a banking. We had 107 loan officers, blew that up, sold that off, and I've always been investing. So during that time period, a lot of my clients were investors, and I just started surrounding myself with like-minded individuals. Just kind of lift myself up. So yeah, I've been doing, my specialty is seller financing strategies, but I've done it all. I've done the land development, even through seller financing, residential, commercial, you name it. I pretty much have done it, except adult living facilities. I almost did one, but I'm out of that right now. It just looked like too much involved, like another full-time job, and I don't want to have that full-time job. So I love buying through seller financing and selling through seller financing and creating that arbitrage, and I don't have to worry about the leaky toilets as much.
Yeah, as a well diversified, high net worth individual, it's interesting to see why someone would pivot into the note strategy from given your background and things of that nature. Why did you gravitate specifically to start to additionally scale seller finance? What was the defining factor for you?
Actually, it was funny because you used the word scale, right? But is actually did the opposite for me because I didn't want to scale in the business aspect of dealing with more employees and more headaches, but I wanted to scale the passive income. And the way to do that, where I didn't need as much management and control and work, was more about creating notes and generating that passive income versus other businesses. You had to have multiple team members and you have more expenses. So I kind of like, it was kind of a little reverse. I scaled backwards of dealing with, got rid of more employees and enjoyed myself, or I didn't have to babysit so much and create that passive income. Does that make sense?
Yeah, I think a lot of people get, head over heels with their business and the sweat equity involved with growing and hiring new employees and things of that nature, as well as the active management needed for long-term rental strategies. It really starts to put you in a corner at the end of the day. And for the want of really financial freedom, at the end of the day, I think that that's a great vehicle opposed to hedging your bets in equities or, sweat equity in operating a business and things of that nature. For you, what was the defining factor to additionally gain that terminal velocity, call it, within your transaction base? Was it specifically getting nimble in your acquisition strategy? Where you bought seller finance, or, there's obviously other ways to structure notes, buying for cash and selling on terms. Was that kind of the defining factor to gain some velocity, or, what would you have to say about that?
No, it was more in the lines where I grew up in poverty in Vermont and I didn't have any money. I didn't have, at 18, 19 years old, I had 28 credit cards all maxed out. And it was roughly, at least there's small limits like $250, $500, but still that's a lot of money for an 18-year-old, you know.
Absolutely.
So, and I knew I had to change, like for me to take charge and do something, I had to figure something out. And I did the old Carlton Sheets. I did a cassette course, and And what I did was I actually like stumbled on it by accident, my first deal ever at 19. So, I went and got cardboard boxes and used a wet magic marker and put "We Buy Houses" and put them up on the telephone poles around my municipality in Vermont. Well, I'm 19. I didn't realize I can't put stuff on telephone poles. The municipality called me up and started yelling and screaming at me. I'm like, oh shoot, I didn't know. So I went to take them down. While I was taking them down, this guy called me up, goes, "Hey, I got this mobile home for sale." Thinking about mailbox, mobile mailbox money, but it's kind of bizarre. That's how it's happened. But I was 19 years old. This guy called me up and goes, "Hey, I got this mobile home for sale. It's worth 21,000. Give me 18,000." I'm like, I'm not interested in a mobile home. Calls me back a week later. He goes, "Give me $15,000. It's worth 21,000." I'm like, I'm not interested. Another week goes by. He calls me back, goes, "Give me $12,000. It's worth 21,000." I go, "Well, do you own the land?" He goes, "No, it's in a mobile home park." I'm like, I'm not interested. A month goes by. Calls me back again. He goes, "Give me $6,000 for this mobile home. It's worth 21,000." I go, I told you I'm not interested. I kept saying it. In the back of my mind, I'm like, okay, this is a deal now. But I kept going like, hey, I told you I'm not interested. But why are you selling? He goes, "Oh, I don't live in it. I got lot rent due, and it's just kind of, I really don't have. I said, I told you I'm not interested. But this is what I'll do to help you out. I'll give you $3,000. He goes, "Oh no, give me 4,000." I'm like, I told you I'm not interested. He goes, "Okay, I'll take the 3,000." I said, "Okay, what I need to do is I need to get a contract because we didn't really have the internet back then, and I had to go get an inspection done." So we made an arrangement to go out there and do that. He wasn't going to show up, but he left the door unlocked or wherever he put the key. I hung up the phone with him, called the newspaper, placed a classified ad in the paper. Um, Mobile home for sale, $25,000 owner financing with $3,000 down. First lady called me up. Her and her husband or boyfriend went out and looked at it. They wanted it. It was in good condition, ready to turnkey. They gave me the $3,000. I took that $3,000, gave to the seller, ended up creating a note for $300 a month over 7 years. That was my car payment, insurance payment when I was 19 years old. So that was in the early 90s. So that kind of gave me the taste. But then I stepped away from it for 5 years, 6 years, and got into the corporate world. But then in the corporate world, I still wasn't making enough money, and I knew I had to get back into real estate to make the money. And that was my first deal. And then it just evolved over time of learning. We all did the fix and flips, we all did the hold, but I really didn't have a lot of money. So I learned how to do um, lease options was my first creative financing strategy. It's called a sandwich lease option. Um, so that's kind of how I first started the whole process. And a lot of times it was like in 97, the market was slower. People couldn't sell their homes, kind of like it's at now. They're sitting for 4 to 6 months. So I'd go to sellers, "Hey, I want to buy your home at a rent to own, lock into a price. I'll take you the maintenance repairs," and I sublet it. And they're like, "Oh, I'd love to do it, but I need the capital out of my home to go buy my new home." I'm like, "Okay, this is what I'll do is I will refinance your home," because I was a loan officer at that time, and then I will go ahead and make the payments. At the time, there were like option arms, 5-1 or 5-1. Are you familiar with the ARM programs at all?
Yeah, adjustable rate mortgage.
Yeah, they were very popular back then, and the rates were kind of where they're at now. They were like 7.5 to 8%, but I would be able to do a 5.25, 5.5, and I would refinance it at 80%. So I took the cash and I made money off that refinance. And I go, "Oh, hey, Mr. Seller, also I want to do your new loan on your new property." Right? So I made money off of that, and I got literally no money down because in the money that they refinance, I'm using that, and they're thinking I'm using that as my down payment, but in reality, I wasn't. And then I would put a tenant buyer in there. So on one lead, I was generating roughly $30,000 on the front end, doing two mortgages and then the option. So that's how I kind of got started into the game.
From the very beginning, walking into a deal that people probably would have just let go to the wayside, because of the negative connotation in manufactured housing, and scaling that understanding of the lending process and originating a note, scaling that into larger level opportunities. Now, love the progression. Maybe you could just touch lightly on, if you remember at all, of the case specific problems you had in manufactured housing originating a note, because that's a way for individuals to start off in the industry with less capital at the end of the day than, say, an option possibly on a single family property. And then we can get into, some of the regular problems that people have originating on how that translates to single family.
Yeah, I mean, knock on wood. I hate this. I shouldn't say I hate to say it, but the more I think about it, that you asked that question on the manufacturing, the mobile home stuff. I've never really had an issue with that, knock on wood. My headaches come from more of the other side of like the single family and really townhomes, like the condos and townhomes. Those are really where the headaches come from. Some single family, um, but you know what it is, and the more as you ask that question, the more I think about it is those type of people that you put into the property, the more of a hardworking classing people, and they do their best on trying to pay their bills. And if there's an issue, they reach out to you ahead of time. You don't have to chase them. That's what I really kind of notice a lot on the mobile home stuff versus some of the other areas, and even some of my rentals and apartment buildings and stuff. We're chasing them sometimes. It's just a different type of clientele, and they're just they take pride a lot of times. Sometimes they're a little dirty, but they take pride in where they live, and they take pride of making sure that their home is paid for and there's no issues. And a lot of times they're handy and they can fix their own repairs instead of hiring people. They're very adaptable in that nature. So that's one of the things I follow. Now, you had a second part of that question.
Yeah, a lot of blue collar people, definitely market contingent. But how does that translate maybe to single family, as notes? Maybe some common problems that people face when they're trying to implement strategy, or, something, a quick tip that you could provide possibly in that accord?
Yeah, it's a little less regulations, because it's considered sometimes, depending on your municipality and your area, you got to look at it, but a little less regulations because sometimes they're looked at as a motor vehicle versus a home. So when you're doing certain zonings and certain aspects of it. Now, the other side of it is if you're trying to put a new mobile home or a mobile home park into an area, that could backfire because they don't want that, because of you said earlier, the stigma is, oh no, mobile home park. But, I purchased 5 mobile home parks in the last 18 months. Now that's shifting a little bit because it's starting to get oversaturated. And what I've seen over the years, and I'm sure you've seen it, like from 2014 to like 2020, everybody was in multifamily. Then they all shifted over to storage facilities, overpaying, and now they're starting to jump over to the mobile home park community. So the pricing is starting to go a little bit higher. So I kind of backed away from the mobile home parks, buying the parks, but not the homes. If the homes are, I mean, you can pick up some of these homes really cheap and and do whatever you need to do with it, and fix them up. You just got to search around versus, yeah, the single family. I mean, it's the same model, a little bit more. It could cost you a little bit more to get into single families versus mobile homes, depending on where you're at in your investment journey. If you're just starting out, I love mobile homes are cheaper, and you don't take a financial hit as hard if you have a oops, like we all do. We all have a oops. We all get hit on the chin. You just need a lot more winners along the way. So when you have a hit on a mobile home manufacturing, it won't put you under compared to sometimes a single family if you're just starting out and you're over leveraging yourself. I can't tell you how many times I've seen people in fix and flips on the single family. Even right now, I see that happening. I'm sure you probably see that as well.
Yeah, having the availability to get a door for less than what it would cost in single family residence. If you end up losing on a 40 to $80,000 unit, it's not half $500,000 bucks. At the end of the day, the dollar goes a lot farther in those doors specifically. And if people, you're not going to make money on every deal. If you think you're going to make money 100% of the time, you're wrong. It's how to outweigh those losses with the wins and ultimately mitigate risk as much as possible up front. That's of utmost importance, but no one has a crystal ball at the end of the day, and how to, like you said, take it on the chin. That's of utmost importance. And number one rule in investing is make sure your investors never lose a dollar, right? That's the minute you go out of business. So, if
You
you
pay
can.
them before you pay yourself. You pay them before
Exactly.
yourself. The other thing about mobile homes, especially in this market condition, single family homes are sitting a lot longer because of the affordability factor, because of where we're at in our cycle of economics right now. I mean, we had major inflation from COVID. We printed a lot of money, and it's just pushed everything out of reach for a lot of first-time home buyers. So um, typically in the mobile homes, they go really quick versus even apartments. I had some apartments right now. I had one sitting for 3 months, empty, and I had to cut the rents by 20% to be able to fill that up. So you're starting to see that pullback in certain markets and a lot of markets. But again, in the mobile home area, long as they can afford it, and you want to be fair as an investor, don't be greedy, just do the right thing. And if you get the right people and take care of them correctly, that you won't have any issues. It's just, they're good people. That's what I found. And you just treat them right. Yeah, sometimes the cousins may have an issue here or there, drugs or whatever, and they need a place to crash. You get that a little bit now and then, but it's part of the game. But most of all, they're really good people. And if you interview and you underwrite them and get a good feel, go with your gut, you can kind of pretty much tell a lot of times.
So, with the current housing crisis and creative financing boom, how do you see that fitting into the next year, with pressurized residential real estate pricing and some other challenges like high rental rates and stuff like that? What do you kind of see with the industry given your position in creative finance?
So it is a tough market, and it's market by market. Like currently in Florida, the numbers don't make any sense currently on the single family, even on condos and townhomes. When you're taking over a property and their seller's got equity in it and you got to pay them like a second mortgage, because typically could be straight seller financing, or it could be existing mortgage, and depending on the strategy, because there's so many different type of seller financing strategies you could use. A subject to is the big buzzword. That's starting to cause a little bit of problem in the industry. Then you have agreement for deed, land contract, seamless lease option. So depending on what the seller's needs are, that will determine on what strategy I tend to use. Like if a seller's not financial distress, there's no way I'm going to pitch a subject to. A subject to is you keeping the mortgage in the seller's name and you're transferring the deed over to you and you take it over. It's a great, great strategy. It's been around for 30 or 40 years. I've done hundreds of those. But again, it's just the numbers in Florida don't make sense because they have the equity and you got to pay them the equity. And then when you add up the first mortgage and the mortgage that the seller for the difference, it doesn't cover what the market rents are. Like we just do it in Orlando, and you're upside down by $700 a month because the prices are so much higher. But one of the things, so like the Midwest markets, the 1% rural market, those markets tend to work to do the creative stuff. But now, what I tend to do is I shift with the market condition. I've always shifted. Like when everybody was doing the wholesaling and they're putting a contracts and they're going up quickly, I was doing the creative stuff. Now the last year and a half, 2 years, everybody shifted over to the creative world because, oh, how are we going to do stuff? Because the host now I'm shifting around and going back over to do buying properties at discounts, properties sitting. I'm offering 35-40% discounts. I'll fix it up and then I'll sell it on seller financing. Creating the note of a first, like a smaller one, like a 60-70% first, and then I'll hold the second, and then you can sell that first mortgage off into the secondary market and do a rinse and repeat. It's kind of like what your model is on the mobile home side. I love that model, what you guys are doing over there. But I'm looking at it also from a single family. The only reason why I'm a single family is because I can go out there and get a quick hard money loan real quick, but I do have capital people that I could kind of put that out there. But I'm in the process of now shifting to using that model. And that's why, I came out and met with you guys because I really, really like the model that you guys have in place. I think it's genius, especially with this type of market condition.
Yeah, love it. Appreciate those, kind words for sure. For the people that feel like they're drinking from a fire hose right now, you kind of talk quickly about amongst a bunch of different strategies that are at your utility. For the capital investor that's sitting on the sidelines right now, looking at Jerome Powell and freaking out because they have it so much reduced big rates, like they promised at the beginning of this year. For the layman, high net worth investor that's not educated in these creative strategies, what would you have to say to them currently if they have money in a money market account, or some bonds or low yield mutual funds, just because really they don't want to get into an issue and they're being told possibly by their FA to stay in those programs when there's real opportunity. What would you have to say about that?
It's hard the last 2 weeks. It's hard to have this conversation with investors because look at what the stock market, everything in the market is just crypto, gold, everything is just, and it doesn't make sense because usually in September we usually have bad time, but at some point you're going to see a correction. And that's actually my wife and I, we're actually having a phone call with an IRA company, and we're actually shifting to put some of our capital from some of our retirement in a checkbook IRA, so we can, when we see a real estate asset, we can go ahead and write a check real quick on it. So again, you want to shift where everybody else is going. I like to go the opposite direction because eventually that's going to explode that particular area. In that, but I think real estate. You could, if you don't understand real estate and you don't want to get out there and do that sweat equity, you don't want to do all that hard work. Put your capital to work. Become a capital partner or create the notes. Be the note behind it. So if the investor defaults, you get that asset, you can take that asset back and you're protected versus some of the stuff in the stock market. It's just, you go with the wave. And how many times have you seen companies go under that had stocks, that we're looking at that type of stuff. So it's always good to diversify. The really educated people that understand their finances, they tend to do that. They don't just leave it all in one place. And you can also use your IRAs to be able to invest so you can keep it. So any type of gains that you get on it, you goes right back into your retirement. So you have that protection depending on how you have that IRA set up sometimes. But I would check with your company how that's, and but I just think it's, you want to diversify and put your capital to work. I mean, that's where a lot of people do, and they don't get hurt when they diversify. And a lot of people don't even realize that you can put your capital, if you have money in a 401k and you left that company and you roll it over to an IRA, you can diversify. The big boys. I have one with E-Trade, and I have an IRA, and I'm like, hey, do you mind if we kind of do some diverse? And they wouldn't allow it. So because they want to keep it, all that money sitting in their assets so they can control it. Meaning they wouldn't allow me to take it and roll it into another alternative investment like mortgage notes. So I had to transfer that whole IRA over to another whole company that allows those type of things. So, and there's, if you guys ever want to know different companies like that, either one of us, you can post it in the comments, and either one of us can kind of hook you up with a couple companies that can kind of help you with those IRAs. So, and I'm sure, why don't you piggyback off of that? Why don't you tell us a little bit about the, what I'm talking about, the IRA? I'm sure you have some good insight as well.
Yeah, most people don't know you can invest your IRA tax deferred or even tax free, depending on account type. We've done multiple workshops with like Directed IRA, who's a great custodian out in the market. So essentially, what you're doing is you're custodianizing your IRA, right? And they're dispersing the funds, and all investment goes back into your IRA, meaning it's a qualified program. At the end of the day, most people don't know you can buy notes, invest in funds, do private lending, invest in syndications with your IRA. I've heard even as far as Bitcoin, of all things, talking about crypto. So what better way to spin off profit? No one's saying, liquidate your whole portfolio at the end of the day. Have a small portion in alternative investments. Mark, better time now more than ever. Why? Because literally they just opened the veil for people to invest in alternative assets with the new executive order allowing 401ks, literal true 401ks, Wall Street money, to invest in alternative assets. For the now seasoned investors, Mark, what do you think that does to the market, having now access now from almost Schwab brokered accounts? What do you think that does here in the next 5 years?
Yeah, they're still trying to work that out because I actually had that conversation with some of the big boys, and they said, "Oh, we're still waiting for the rules of that coming down the pipeline." So I think that's great. People that are educated with their own finances can go ahead and put other alternative investments. And if you're not educated, you should become educated. I have a good buddy of mine. He bets in football. He's a huge college and pro, right? And he'll sit there and he goes, okay, he'll bet. The reason why he's taking this bet is because this person's injured and that, and this, and this person's, coming back from injury or whatever it may be. So he knows all this stuff. But then I asking him about, his retirement. He has no clue. He just gives it to people and manage. I'm like, wait a minute. You have all your money in your retirement. you don't know what you're doing, but you know what you're doing over here betting football. Something's a disconnect there. And I'm like, you know what I mean? You need to understand your finances, and it's not that hard. Don't be afraid. You know, a lot of us, you know, growing up, if you haven't done the book Rich Dad Poor Dad, highly, 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 I can't stress it enough, to read it, listen to it, whatever, because it's going to give you an education. I think that's the best place where to start is 101, understanding how your dollar and how money works for you and how it can go further. And I kind of went down this whole path and I forgot where I was going with this whole conversation. But anyways, it's just understanding your finances. Oh, I know what it was, the 401k. That's sorry. Yeah, I think that's awesome because you're going to be able to understand how to control your own finances and investments. Have a good idea. Don't go crazy. Don't go like, hey, my buddy told me about this penny stock tip. Be cautious. Or you never heard about this crypto. You know, stick with names that you know and people that you know that are running it. And it really comes down to, like, if you look at Warren Buffett's model when he buys a company or invests in a company, it's always the management team. So if you're going to do an alternative investment in something, make sure you do your due diligence on the management team, that they know what they're doing and how long they've been in business. They're not a fly by night, or, you know, some of these multifamily guys, they're getting cash calls that they didn't evaluate the numbers correct. And I still see some of these guys out there raising capital. I'm like scratching my head. I'm like, oh my God, this guy's getting, you know, he can't perform on this. He did a loan on a value add. He owes $34 million. Now the bank's calling it due because when they redid their numbers, they didn't do the model correctly. I'm like, but just make sure you do your due diligence on that stuff. But I love it. It's going to open the floodgates. And, you know, it's, you, like you said, you probably want to jump in it now, because when they open those floodgates for 401k, there's going to be a lot more capital. So us people, we're going to be, instead of giving our capital partners high dollar, we're going to be able to bring our returns down to people a little bit. So you probably want to get out there and get into this stuff now, since, and build that relationship, because when all that money starts coming in, like if you're buying notes or real estates and stuff, you know, us as the operators, instead of having to give 14% or 10%, we may be able to come down to 8 or 9, because we're going to have so much coming in, we can't put it all to capital to work.
I see that for sure coming, to be determined here in the next year. I think you had a couple really great points, choose the jockey, not the horse, branding. You got to find someone that has great branding and can stand behind what they do, out in the market. You've branded yourself fantastically, had one of kind of the first movers advantage in a Facebook group that's called the Seller Finance Homes, correct?
Right. Yeah, we got
You can just talk
180,000
about that group
members.
real
Yep,
quick.
180,000 members over there.
Boom. So what do people do in the group? How does that interact? What do you see? Where do you see that going?
They're doing, I mean, there's some people making some serious money in that group. I mean, I was out like not too long ago at a restaurant with some friends, and this guy comes up, goes, "Hey, are you Mark Monroe that runs that Seller Finance?" I'll go, "Yeah." He goes, "Oh, I bought this deal from the group," and he's going, he ended up making like 200 and something thousand dollars off of some deals in that group. I'm like, wow, it's
Nice.
impressive. So the group is like people buying and selling seller financing homes. You can kind of go through that process, but also educating people have capital that want to deploy capital to work in some of those. So yeah, it's great. If you want to try to go Facebook Seller Financing Homes, or right here is my URL, my name, mark-monroe.com. If you go there, there's links to my social media stuff over there. So that will kind of help you get there if that's something you're looking to try to join. So it's www.mark-monroe.com. So anyways, this is great, and yeah, it's all about branding and marketing and making sure, and you hit the nail on the head, is you said something earlier about, you're going to take some hits on the chin. Make sure you're taking care of your capital partners first, and be upfront. If something's happening, be get out there and get ahead of it and have those conversations. Don't have them come to you. Your name means everything in this business, and you need to be standing character is one of the biggest things. And like you say, for me, I'm old school. My whatever I say, I'm going to stand behind it, even if something happens. Hey, it's happened. I've lost some stuff because I want to make sure the people I do business with, they're protected.
It's doing business with people like, and trust at the end of the day, and if you can find those relationships, the money will come at the end of the day. standing on business, really. I've seen Mark at multiple real estate note investment conferences, from Diversified Mortgage Expo, the Note Expo with Eddie Speed and Nathan Turner. I've had him on the channel a couple times. Vlog 109 interview at Diversified Mortgage Expo. We're here, podcast episode 32. Mark, any conferences that you're going to here in the next couple months worthy of conversation? Or
Well, I
where
just
can
got
maybe
back.
someone meet you?
Yeah, I just got back from Cincinnati at the Bird conference. I was up there. I was going to go to the No Conference Eddie Speed Scouting one. I'm actually going to be jumping on a call here right after you at 2:30 Eastern Standard, my time. Was it like 10:30 your time? Is it out there, or
11,
11:30?
12 here.
Yeah, yeah, something like that. So we're jumping on. We're gonna talk about that. We'll probably go live in my group here, just talking about what's going on there. I won't be there. I'll be traveling outside the country. I'm actually getting ready to leave Friday for Greece. We're doing a Greece trip, and then we decided this morning we're going to hit Dubrovnik on the way back through. So then we're extending it a little bit longer. So that's why I love this, because you can do business nation worldwide. I was going to say nationwide, but worldwide. The only problem is you have to start doing some of these calls like at 4:30, 4 p.m. because of the time zone difference, which is okay.
You've manufactured a life of financial freedom and doing business remotely from your phone, or make sure you have internet at the end of the day. But you can really do this business from anywhere. And what does that translate to? Spending more time with your family, your friends, building lifelong relationships, and becoming the bank. That's what we call mobile mailbox money. Today's brought to you by Silvercrest Opportunity Fund. Mark, if someone wanted to contact you, how would you direct them to do that today?
Just if you want, just search my name on Google, Mark Monroe and real estate, and you'll see everything that pops up there. That's the easiest way. Mark Monroe Real Estate, MarkMonroe Real Estate, or my website. It's Mark the -Monroe.com. So I really appreciate it. This has been phenomenal.
Boom, love it. Thanks so much for coming on the channel, Mark. Don't hesitate to reach out to Mark here today, or join his Facebook group. Start making hundreds of thousands of dollars, or learn how to operate creative finance, or really just get curious and take one step closer to your want for financial freedom.